I thought a great analogy I saw reported the other day was thinking of trade as a tsunami, right? So we had the trade earthquake when these deals were announced, the 100% plus tariffs on both the U.S. and China, which has really frozen trade between the U.S. and China since those were announced. And so there's these ships that are coming across the Pacific slowly. When they arrive here, or if they don't arrive at all, that's going to be when the trade impact arrives, and that's going to be in June, maybe late May, June, July. That's when it's going to really kick in. That's when you'd hypothetically see empty shelves. That's when you'd see price increases because people have to build in 100% tariffs into their products.
Welcome to Rise Up, where we take a look at the biggest stories of the week and break them down to help you understand what's happening in the market, how to grow your portfolio, and protect your portfolio. And we know there's a lot of uncertainty going on right now. And so we want to be here at Rise Up to help bring real conversations with experts in the industry to help people with various different conditions with their portfolio. So my name is Terry Carlson, and I'm the co-host for Rise Up. My partner, Joe Duran, who usually is here, is not here today, but we do have two excellent guests with us to help us think through some of the tariff changes that are happening even as we speak today. So first off, we have Emily Wood with us. Emily is a CFP, a principal at Grimes & Company Wealth Management. Welcome, Emily.
Thanks, Terry. Happy to be here.
Awesome. And we also have Ben, who rejoins us. Ben is a CFA. He's a research director and a portfolio manager from Grimes & Company. Welcome, Ben.
Hi, Terry. How are you?
Very good. Today, is a little bit of a bright spot in the day. It's topping our story, really, with the new trade deal that was announced regarding the UK. President Trump announced the deal from the UK, Oval Office today, with the final details not being announced yet. But he said that this deal includes billions of dollars of increased market access for American exports. Last week, the U.S. said it was close to a deal with India, also with South Korea and Japan. The Treasury Secretary Bessent will be meeting with the Chinese delegation this coming week in Switzerland. Ben, we'd love to hear from you. What is your perspective on this? Can we see a touch of optimism here?
Well, I think there's been a decent amount of market optimism lately on sort of progress on the trade front over the past couple of weeks. I think the deal itself, the economic impact isn't tremendous. It's really the idea of, okay, this is the first deal. What is the framework for subsequent deals? And there's pros on that. The number one pro is we have a deal. We've actually gotten our first deal done. I guess I would say if there's any bad news to it, it's that we're still sitting at a 10% tariff with the UK. And of all the countries we could have done a deal with, perhaps it's a little ironic that the first country we picked, we actually had a trade surplus with. So when you sort of pivot to some of the other countries, there's going to be questions. But as you alluded to, the real movement we actually saw in the market was during the press conference, not when talking about the UK, but when President Trump started talking about China. So there's some optimism that what's been going on with China can actually see some positive steps.
Yeah, maybe hopefully this first step will be continued follow-up positive steps with some of our other trading partners. But, if we just thought about some estimates here in terms of good news, right now there's a thought that this could increase exports, maybe up to 5 billion in new U.S. exports, which is a real positive for our economy. Then ultimately that could be potential job creation because we're expanding that U.S. goods. This is expected to really help some of our growth in jobs. And then tariff revenue, their estimates right now about a $6 billion increase in tariff revenue as a result of this deal. Emily, I know you have clients. They're always asking about this. What do you tell your clients right now in terms of this particular deal?
Well, I think it's nice to see things moving forward in a positive direction. We've had a lot of clients who just feel unsettled right now. And so I think moving a couple steps forward is helpful. One question we're getting a lot is, if this trade if these tariffs are prolonged, is this going to lead to a recession? And so, of course, we don't have a crystal ball and we don't know what's going to happen. But given that recession is just in the normal course of events, we typically have one every 4 to 5 years. That's not something that we would get overly concerned about by any measure. It's also important, try to keep clients into perspective that the market is very forward looking and quicker to react. And so it will react to good news, price that in quicker, same with bad news. And so if we were to have a recession, typically that market sell off is going to be at the start. It'll also be quicker to recover. So, that wouldn't mean market doom, but we will absolutely take this as a bright spot today.
Yeah, it is a bright spot. But as you said, Emily, we're not out of recession fears at this time. And we think about supply chain management and what this is doing. And we already mentioned China, but I live here in California and the ports are really important. I don't live far from the Oakland port, the Los Angeles ports. And I just read recently that, US shipping has declined 60% since April 9th out of the Los Angeles port across the Pacific. So we're starting to see, potential signs that even though we're solving it in one area, there's still big things to tackle moving forward. And so, I think it's really important. The other component here is just trucking alone. And I did some research on that. Trucking deliveries are actually down almost 6% from about a year ago. So we got one good thing, but we've got other things looming. And so something we definitely need to keep an eye on through this show and keeping our viewers informed. Now, let's go to the market per se and what the market reaction is to all of this. And not surprisingly, we saw some positive news today. The S&P was up about 1.2%. And so, Emily, again, your clients are optimistic potentially here, but what are you saying to your clients and what are their biggest concerns?
So clients are, they depending on where they're coming from. So for retired clients or people drawing on their portfolio, a big concern is how are they managing liquidity through the volatility? They want to know that they won't be forced to sell stocks when they're down to fund their lifestyle. And then in those situations, we're usually doing things like having dividends and interest pay to cash to create an income stream. And we've got enough allocated away from stocks to fund several years of distribution. So we won't be in that position where we need to sell stocks when they're down. I think clients, I guess, much like the markets, also don't like uncertainty. And so, we just want to keep them on track. We want to make sure that they understand not just what's your allocation, what's in stocks and what's in bonds and what does that mean, but underlying what are the strategies that we're using and how are we managing risks. And I think once they have a better understanding of their portfolio and our thought process behind it, it's easier to have them stay the course confidently.
Ben, do you offer clients any advice during this time?
Well, again, the main thing that we're talking about is your portfolio should be set up with the appropriate diversification, the appropriate strategies, so that when you do have periods of volatility like we've had, you aren't having to shift your path in response. You should automatically be taking steps, or you should be prepared for things to come up like this. And again, as Emily alluded to, the number one most important thing you can do is if you have clients who are in a situation drawing income, it's having that cash balance always there to meet that 6 to 12 month income need. And once you have that level of separation, that gives clients much greater comfort in what the markets are doing, and then it allows the rest of the portfolio to do its job.
All right, that's very helpful. Now, we all know there's a big event coming up this weekend, Mother's Day weekend. And so one of our third topics is really about celebrating moms, but celebrating working moms who are trying to manage all these components. And we have some new updates from the financial advisory field. So today, working moms make up about 40% of total income for families today, which is a substantial amount. And if both parents are working, the dual income sets up even more success for saving in the long term, like home ownership, education, and retirement right now. And so we're starting to see that if you have dual income families, you've got matching 401ks, two 401ks. And this is all a positive. We've got a lot of working moms out there. Emily, I'm sure you have working moms. What are some of the benefits and concerns that they have about being a working mom?
Yeah, absolutely. To your point, it's always really interesting to read those statistics and see that there can be a pretty significant benefit to these dual income households. And certainly, whether or not to work outside the home is a very personal decision that can vary family by family. But we're also seeing, interestingly, fathers picking up more of what I would call the default parenting, so that some of these moms can have slightly more intense jobs outside of the home. And so I think financial services in particular can be a great industry for working parents, dads and moms alike. Gone are the days where people were at their desk bell to bell, and they couldn't walk away. So there is a lot of flexibility in this industry, and with the hybrid arrangement that a lot of firms have, it's giving people more flexibility to maybe be there for pickup, or sneak out during the day for something. But it's really empowering, I think, for women to be working and be saving, and also to have a voice in what's going on in our household finances, and have a really clear picture of what does that mean, and what does our contribution mean, and how will this set us up for the future.
That's right. About 74% of moms that have children under 18 are currently working. I mean, that's a significant stat. And then about 68% of moms with kids under 6 years old participate in the workforce. So this is a growing statistic that we need to make sure we're helping and supporting all dual income families as well as single income families, because they have unique situations in planning for retirement and planning for college funding and so on. But when we just think of advisors, let's just go now to what's near and dear to our hearts is advisors that are moms, right? So people help, just like you, Emily. You're the perfect model for what I'm talking about. You're a mom. I think you have 3 kids. Is that right?
2 kids, yep. It
2
feels
kids?
like three sometimes it
Yeah,
feels like four, but
exactly.
yeah.
And so let's just talk about how moms your age and your life stage feeling. But work-life balance is one of the most critical factors for women in this industry. And there was a research done that said 9 out of 10 working moms are very satisfied in their job. And what is that correlated with? The ability to work with clients from home or on a flexible schedule if they're in the office, really the friendships, the relationships that they build with their clients built on trust and caring. But Emily, how do you tend to manage all of this as you think about your role in helping people make better financial decisions, but also helping families?
Absolutely. Well, I think it gives you some perspective when you can talk to someone about, I'm saving for college, or, oh, gee, you wouldn't believe what childcare costs, or, I've got these kind of dueling goals of doing things for the kids, but also saving for ourselves, big picture. So living it, I think, does really help. And you mentioned in particular how much job satisfaction there is with working moms in the financial services industry. And, I can certainly vouch for that. I'll tell you, the majority of my team is working moms. Some of them have kids who are young adults or maybe are in college, and then others are still, they're dealing with the juggling of preschool and grade school age kids. And so, again, one great thing about this industry is that we're here to work with clients, and so we want to meet with clients when the clients want to meet. And if that means that, sometimes we're logging in a little bit later in the day to fit in a meeting, that's great. I'll tell you, on Wednesdays, I'm always jetting out of here at 3 o'clock to get to my kids' lacrosse games. And then I'm usually online a little later at night just to wrap up the day. And so it really is satisfying to know that you can do both things, and you can do them well. To be a working mom, you can be a fantastic worker, boss, advisor, whatever that means. And you can still be there for the kids during the day. So I feel really, really fortunate to be in an industry that I think builds us up and helps us to succeed. And also, to have a team that's having that same experience.
That's exactly right. And Ben, you're a working dad, which are just as important. And what are your thoughts on this?
Well, I was thinking an interesting relationship to where our conversation started. We were talking about short-term liquidity, having cash to meet those periodic short periods of crisis that you might see. Well, I think a lot of times with parents, most of the day their work life is under control. The kids are in school, they're at activities, etc. But you have those things come up, whether it's doctor's appointments, getting kids off the bus, little changes that might not go on every single day. But if you have that flexibility with your job, you can get out and you can just get those one little crises here and there, and that really helps make the whole experience much better. And so we obviously strive to give all of our employees that type of flexibility, because if our employees are less stressed with their home life and that situation, they can be less stressed with their work life and obviously service our clients better.
Absolutely. And I think that's where the team approach really comes into place. We talk about, oh, it takes a village to raise a family. And sometimes it feels like the same is true here in the office, where if someone's jetting out because, like Ben said, their kid is sick and needs to be picked up in the nurse's office and they've got a client who needs something, there's a whole team so that we can step in and we can help out that person who needs the help that day. And then the client still has that seamless experience that they're used to.
That's excellent. And I think what it shows is there's just no one path to success here. And if anyone's watching, I would just say this industry is an excellent industry. And if you're interested in becoming a financial advisor, maybe even at Grimes and Company, please reach out at Wealthion and we'll tell you all about it. But it is an excellent industry to be able to help people and still have some flexibility in your life. Let's go now to our big topic and our conversation last week on market volatility and answering our viewers' questions that have struck a lot of nerves. We've actually had a debate between two of our viewers. First of all, Hawaii Hiker Guy 3152 says, just buy the dips and you'll be great. And if you are retired, you shouldn't be in equities. But then Ray Machechi 8869 reported by pointing out that retirees have a record 80% equity allocation and asked, are they really going to be great? And Ben, I know you deal with this all the time. What are your thoughts here?
So the 80% equity statistic, that references to individuals who are 55 and over owning 80% of all equities. And when you look at sort of the wealth accumulation life cycle of individuals, it tends to peak in the 55 to 65 period when earnings typically maximize, saving maximizes, and then they're building it for retirement. And then they get depleted over the course of retirement. So it's not just 80% of all stocks that age 55 and up owns. It's actually 80% of everything, just because that's when people tend to have their most significant asset base. That being said, it is important for folks to continue to own stocks when they're entering retirement and in retirement. There used to be this perception that as soon as you retire, you have to put everything into bonds or into the bank and stop earning. But listen, we expect, we want our clients and expect our clients to have long, healthy lives even once they're in retirement. Part of the reason why people save to retire is so they can have more interesting lives post-retirement. You can, life expectancies, you can be retired for 15, 20, 30 years. And so if you're talking that time horizon, of course you should have an equity component to what you're doing. But then coming back to our initial point we talked about on this call is that you want to have that appropriate liquidity for the short-term stuff so that you can own the equities for the long term, but you still have that liquidity buffer for that 6 to 12 months of cash needs. So you're not forced to transact in a market that might be volatile.
And Emily, you're working with retired clients. What are your thoughts?
Yeah, I agree with Ben. It's funny. Sometimes we'll have people retire, and one of the first things they want to talk about is, well, okay, where's my retirement portfolio? What does that look like? And often the retirement portfolio looks exactly like their current portfolio. Again, we might make tweaks. We might stop reinvesting interest and dividends and have those pay out, or depending on their allocation, maybe we will dial back the stock a little bit. But if you've got a multi-decade long time period to plan for, there is room for risk in the portfolio, and we do need that long-term capital appreciation that will help the portfolio continue to grow even as they're taking distributions. So I think once you walk through that with clients and explain the different pieces of the portfolio, what they're supposed to do, what risk can mean, and how we'll structure those distributions, they do have a much better understanding of what to expect, but also a much better a higher comfort level with potential volatility and understanding, well, where does this fit into the portfolio?
If I were to summarize what you just said, overall, Emily, equities in a portfolio, especially for retirees, they combat inflation, right?
Absolutely.
If people live longer than expected, you need that actual equity growth. And, replenishes withdrawals, like what you said, and improves risk adjusted returns. And I know you guys have heard this before. I don't know if you agree with it, but a lot of times people will use the kind of the general rule of thumb of 100 minus your age should be your equity allocation. Now, that's a very simplified version, and I'd recommend working with an advisor. But if you're 100 and you are 70 years old as a retiree, you should have about 30% in your stock allocation. But because people are living longer now, maybe it's 110 minus your age to get to that equity allocation. It's just another general rule of thumb so that you can actually accomplish some of the positives of having equity in your portfolio. Let's move on now to our big topic. And this is the question that comes from Shannon in Cos Cob, Connecticut. So you guys probably know where Cos Cob, Connecticut is. But this question, there's been a lot of talk about market volatility in retirement, but what about all the 529 plans, right? We've got a lot of families out there with kids going to college in the next year or two. Some plans may be more on fixed income, but still these plans are experiencing quite a bit of volatility. Ben, what should Shannon from Connecticut be thinking about here?
Well, it's funny. Completely coincidentally, I'm in the same boat as Shannon. I have a daughter who is graduating high school this year and is actually headed to the University of Connecticut. So perhaps we'll be in her neighborhood before she knows it. So I've been thinking about this a lot as well. But really, the big thing is, unlike the retirement situation we talked about, when you have, people think they get to retirement and they have to immediately convert to cash. This is actually a situation where you might have a very short time horizon, just 4 years. So obviously, when you start out your 529 account, hopefully when your child is much younger, you're going to start out with a much larger equity weighting in the portfolio. But by the time you're getting to that senior year, you want to be already getting it more conservative, and there's certainly formulas that you can use there. But then, once you get into this really on the window of having to pay it out, you definitely want to be more in fixed income. You can still have a small equity slice. It depends on, what the final time horizon of the account might be. But you want to be in that fixed income. The nice thing these days is actually you're getting decent yields on the fixed income side. There's still volatility because interest rates are bouncing around. So what you want to complement that with is make sure, look at the next semester or two of expenses. You should know what the tuition is going to be. Is it all coming from the 529? Do you have some cash on the side? And you really you do want to budget it out so you know that you can take some of the 529, put it into cash, put it into the money market. Because what you don't want to have to do is when that tuition bill comes due, it has to get paid. And so you don't want to be a situation where the market volatility is a concern. And so you manage that just with a greater focus on liquidity.
Yeah, one thing to add there is we've seen over the years of the age-based funds really picking up in popularity for the 529s. And so much like your 401k, where you might have a target date fund, which gradually gets more conservative as you get closer to your retirement age, the same is true for these age-based 529s. And we were just talking about how you still probably want to have a fairly healthy allocation to stock when you retire. It's a little different, like Ben said, as you're getting ready to head to college. So a lot of these plans, as you get to that starting point of college, they are upwards of 85% allocated to bonds and cash. So they get pretty conservative pretty quickly because that 4-year time horizon is much, much shorter than the multi-decade time horizon that we might be looking at for retirement.
Yeah, that's a good, I think, decision around timing overall and the time length. But let's go on to our other topic. And this is a big debate with our Wealthion viewers. And, have we hit bottom yet? This is a really important question. Our Wealthion viewers have voted. And so a lot of them are responding. About 1,000 have said that, 71% of our viewers today think the markets hit bottom in the next 6 months, while 20% think we've already hit bottom. So Ben, you're a research director at Grimes. What are you seeing in terms of hitting bottom?
Well, it's interesting. Normally, when we're in a market environment like this, we'll sit and we'll evaluate, where is the credit cycle? Where are the economic indicators? What are they doing? Are they showing signs of stress? But really, in this particular cycle, there's one thing driving the market, and that's these tariff and trade headlines. And so, if it turns out that going back to Liberation Day, that immediate sell-off was enough to send a market signal that, you know what, this tariff policy wasn't the right policy, we're going to take steps and start negotiating, which is what we've seen since, then you could make the argument that that was the bottom. However, there's also plenty of potential. Again, the 90 days are up on July 9th. I imagine we're going to be seeing some volatility because we're not going to be having every single company get sorted out. Every single country gets sorted out before then. And so there's going to be questions. Is it going to be, is China going to be fixed by then? India, Japan, South Korea? And honestly, we don't know. And it's all going to be based on that. And then the final piece I would say is even where we are now, we've had such a nice move off the bottom here. Just going back and retesting the lows, which is a common thing to see when you have a sell-off, is another 12% downside. So whether the bottom is in or not, that's always a tough thing to gauge. And honestly, we tell our clients not to obsess about that stuff too much. But I would expect the volatility in the markets, the ups and the downs, to continue from now, certainly through July when that first deadline comes up. And so anticipate that, and therefore when it actually happens, hopefully that will be less stressful. Have your portfolio ready for it. And then the final thing is, if you were the type of investor who 2 or 3 weeks ago was sitting there and like really, really worried about where your portfolio was, perhaps you had some upcoming expenditures, perhaps you didn't quite have enough cash on the sidelines. Now's the time when it's hard to guess where the markets are going to go, but it's really easy to see where the markets are. And so we've had this bounce up, this recovery up. We're only 10% off an all-time high in the markets. You can make those trades now, make some adjustments if you were worried about it. And so you can take advantage of that if you felt like you were sort of caught off sides, back in earlier April.
That's right. And Emily, a lot of self-directed investors are trying to time the market right now, where if they had an advisor, they have someone to talk to and coach through these times of, big ups and big downs. What are you telling your clients, especially those that might have some self-directed in another account somewhere?
Well, it's impossible to time the market, as I think we all know at this point. Sometimes when people want to get out and wait till things feel better, you can get one side of that trade right sometimes. You can get out and then see the market move lower from there and feel a lot better. But the $1,000,000 question is, well, how do I get back in? And typically, think of the global financial crisis. Nobody thought that early March 2009 was the best time to get back in the market because it felt about as bad as it had. But that would have been the perfect time. And a lot of these market timers, they missed that 2009 bounce, and that's the type of thing that can really kind of cannibalize portfolio growth going forward. Conversely, I've talked to a lot of clients who have had some cash outside, and they used April to put a little bit of that to work. Some of them wanted to make a couple trades on different days. I've got other people who are in a dollar cost averaging plan for the next 3, 6, 9 months to try to take advantage of what we anticipate to be, a volatile market in some form going forward.
Yeah, we've talked about that on this show before. You can get back in, but go in small doses. And dollar cost averaging, I'm glad you brought that up, is an excellent way to get back in, but don't take some of the risk of all at one time. Emily, I'm really glad you brought up 2009, March of 2009, because that was, there was a lot of capitulation in the markets. The Fed came back, and there's been a couple other bear markets that we started to see the bottom out. And usually Joe Duran covers this because he's the oldest guy in the group, but don't tell him I said that because he's not here. But I thought, well, since we don't have the old guy here, let's just take a walk down memory lane. March of 2020, during COVID, we saw the massive VIX spike, right? We saw policy support and then a fairly rapid rebound. So the VIX is an important component in looking at this overall. And then in October of 22, which we were all around at, we saw peak, customer or client sentiment. Pessimism was very, very poor at that time. We also saw, improving inflation, showing inflation was softening a bit. So we were starting to see some things improve after that consumer sentiment was so low. So that's a walk down history lane. We know how it's worked in the past. We don't always know how it's going to work in the future, but I'm sure the old guy will be back soon with a few lessons for us. So. Okay, well, let's just talk about next week because this is another big week coming up. Ben, the CPI and other inflation indicators are coming out next week. We've really coined these here on Rise Up. It's BT, before tariffs or after tariffs. What are you looking for overall?
Yeah, so I have to admit I'm a little jealous. Kevin 2 weeks ago, my colleague was on this call, and he put out the before tariffs term, and I normally try to get the terms out before everyone else, but he beat me to it on that one. But it does reflect a conversation we were having at that point, and we're still having, is that economic data is lagging, and most of the economic data we're talking about is from periods prior to the tariff announcement on April 2nd. More importantly, that was just a tariff announcement. There actually wasn't a whole lot of tariffs actually enacted. So the impact on the economic data isn't even in the system. So when we're looking at something like CPI next week, yes, it's April CPI, but no businesses, no consumers were responding to it. It wasn't even reflected in the prices. So yes, CPI will be nice. It'll probably tell us that inflation was under control. That's most of what we've seen. We know the first quarter economic data was pretty good. But again, all that stuff was before tariffs. So it's interesting, but really what we're trying to figure out is where the economic data is going to be in the next 2 to 3 months. And it's interesting, Terry, you brought up the what's going on with the Port of Los Angeles and Long Beach. I thought a great analogy I saw reported the other day was thinking of trade as a tsunami, right? So we had the trade earthquake when these deals were announced, the 100% plus tariffs on both the U.S. and China, which has really frozen trade between the U.S. and China since those were announced. And so there's these ships that are coming across the Pacific slowly. When they arrive here, or if they don't arrive at all, that's going to be when the trade impact arrives. And that's going to be in, June, maybe late May, June, July. That's when it's going to really kick in. That's when you'd hypothetically see empty shelves. That's when you'd see price increases because people have to build in 100% tariffs into their products. And that circles back to, that's why these tariff talks with China are so important, because if they can make progress on the tariffs between US and China, even if it's just knocking them down a bit, that could really free up the trade, and that can take the pressure off the economy. So it all comes back to tariffs. I feel like a broken record on it at this point, but that's what's driving the markets, and that's why.
Well, it's nice to see at least some optimism despite the tariffs. But you've also mentioned another index that you watch pretty closely, and it's the Empire State Manufacturing Index. Can you tell us about that, Ben?
Sure. So I talk about, we just talked about the before tariffs numbers. Another set of numbers we look at are manufacturing surveys. Those are more forward looking. And so this is typically where, if we're talking about a tsunami, this would be our tsunami warning system. Because these ask businesses, how do you feel about how things are going? The two big ones are the ISM and the PMI. They're big, they're national. Those have been weakening a little bit. They've ticked down a couple points. They're sitting around 50, which is kind of their neutral point. But then there's two Federal Reserve surveys, the Empire State Survey, which is done by the New York Fed. Then there's the Philly Fed Survey, which is, just on the opposite side of New Jersey there. So, but these are two big manufacturing surveys. They're both centered around zero. The interesting thing is the good thing is they give a quick read. They actually come out before the major surveys. The downside is they're pretty volatile. So, for example, last month, the Empire State went from -20 up to -8, still negative, but feeling better. On the other hand, the Philly Fed went from +13 to -26, a really big drop. And so really what we're seeing from those surveys isn't necessarily about things being good or bad, but they've been really volatile over the past 2 or 3 months. And what that's really reflecting is the uncertainty that businesses are seeing right now. And so businesses are more uncertain than negative at this point, which is, it's a problem because when businesses get uncertain, they just stop doing stuff. And we are hearing this from, for example, earnings reports from companies. But the good news is, and this is what we always come back to on the trade front, the trade headlines are reversible. The bad news on trade can go from a negative to a positive. So again, if we see progress on trade, these sort of uncertain surveys could turn around and start to go positive again before the hard economic data, things like, unemployment, industrial production start getting worse. So again, we're monitoring it as an early warning sign, but really the best warning sign we have out there is the stock market. And we saw it react very negatively in April, but we've seen it improving since then because the headlines have been getting a little bit better.
And Emily, your clients are reading these headlines too. What are some of the things you're telling them to try to keep them calm during this regular volatility or new headlines?
Yeah, it's the end message is stay the course, right? And even if they want to be making changes, this isn't the time. And so I think heading into these volatile times, trying to paint that picture of, this is normal, this is to be expected. As I was doing reviews at the end of the year last year, I talked a lot about, okay, we had a good year, but looking ahead, I would anticipate some volatility. I also think that just communicating with clients is very important. We try to write blogs pretty regularly about what's going on right now and send them out to clients. And then, of course, just communication, sending a quick email. You might have seen this trade and here's what's going on. Or, a quick call. I know you can sometimes get nervous. I just wanted to check in and see how you're doing with things. But clients, I think, do understand that volatility is normal. The market doesn't only go up. And, most importantly, that we're here as a resource when they want to talk through, what they're concerned about or what they're reading or what they're hearing about at the neighborhood barbecue as far as, financial topics du jour.
Yeah. There are some viewers that we have because of the bull market and the length of it that, really haven't experienced anything like this before. We have some younger viewers. And I think just hearing you as a fiduciary, meaning you're always doing what's right for clients, coaching, calming, proactively sharing perspective that this is normal. We can expect this many times throughout our lifetime, I think would be so comforting to your clients. So Emily, thank you so much. I want to wish all of our viewers a wonderful weekend. And for those of you mothers, fathers, happy Mother's Day weekend. It should be a great weekend for everyone to celebrate at least a little bit of optimism out there. But if you've heard of anything during the show that you have questions on, you want to comment, please subscribe and follow us. Send in your questions. That really helps engagement with our conversation so we know what's on your mind. And of course, if you'd like to talk to our advisors at Grimes and Company Wealth Management, please go to wealthion.com/portfolio and free portfolio, and you'll get a portfolio review and have a chance to talk with them. So thank you so much, Ben and Emily. It was a great show. We really appreciate it. And we'll see you next week.
Sounds good. Thanks, Terry. Happy Mother's Day to you too.
Thank you.
Thanks, Terry.